Hi, welcome to the show today. So today we have a very special guest and I'm sure you're going to learn so much from this. Today we will be talking about insurance and investments. Today we have Chi. She's a life insurance and investment broker, so she will be giving us details on and the importance of having such, especially here in Canada. So welcome, Chi. How are you doing?
Thank you very much. I'm fine. I'm happy to be here.
Yeah, we're happy to have you too. So your story kind of interests me and is very intriguing because she was a lawyer in Nigeria before coming to Canada, and when she got to Canada, she kind of switched to an investment broker and life insurance expert. So it's very inspiring, and life insurance is not something that Nigerians lean towards. They don't really understand what it entails. So we're happy to have you here today so that you can shed more light on it. Okay, so Chi, please, what is investment and life insurance, and why the change from law to that?
Let me start from the change from law
to...
So coming to Canada, Canada is a place where the professions are controlled.
Yeah.
So it's not like maybe a medical doctor in your country and you can come and just start practicing medicine. So to be a lawyer here, it's time consuming, requires funds and everything. So you have to go through the licensing process before you can be called to be a lawyer. So it's not like I gave up on that. It's still a process.
Okay.
But while doing that, I'm looking for something that it's not just so off my passion.
Okay.
Something that is still in line with compliance and helping people. So I actually took out life insurance myself without even understanding what it entails. Then I was lucky to meet somebody who was nice enough or passionate enough to educate me on what it can hold for me, not just having a life insurance and somebody benefiting after I'm dead. So I had to learn, go through the education myself, just to be self-informed. But in the process, I figured that why not go into this as a career? Because I end up talking to friends about it and all. I'm like, oh, why not make money out of your passion? Because I became passionate about it. Like you said earlier, Nigerians, life insurance is like, it sounds more like a scam to us. People take your money and there's no payout.
And people, they don't like talking about debt. So.
No, and we don't like, it's like whenever you take a life insurance, it's like you're dying the next day, which isn't really the case. So what is life insurance? Basically, put in simple terms, it means it's a contract between an insurance company and an insurance policy holder, where the insurance company promises to pay a certain amount of money in exchange for premium upon the death of the insured party. So they could be 3 or 2 persons in the contract terms, which is the insurance company, the insurance policy holder, and the insured life.
Oh, okay.
So the policy holder could be the insured life as well. Then we just have 2 parties. But at the same time, he could insure someone else's life. Like say I could insure my child's life. So then we have the insurance company, me as a policy holder, and the insured life.
So for me, really, I never understood the relationship between investment and life insurance until I met you. So, and it's very interesting that you can also make investment while doing life insurance. Can you explain how they relate?
Yeah, so I was simply saying, I think it's easier if I tell you the types of insurance, life insurance we have. So we have the term insurance that I think people know about it. It's just simply taking out insurance in your life for a specific time. It could be 10 years, 20 years. Sometimes the time of that insurance might be that you can renew after the period expires, or sometimes it just elapses, so there are different things that governs it. Then we have permanent insurance, which means it lasts till it only lapses when you're dead. So, and under that we have the universal life and the whole life. Now the difference between universal life and whole life is that whole life is you participating in an insurance company as a shareholder. So it's still...
So it's like buying shares from an insurance company.
While your life is insured. So permanent insurance, when you talk about, is where you have the investment aspect, because in permanent insurance we have 2 sides of it, the insurance and the investment, there's an investment portfolio. So when you pay your premium, a larger percentage of it goes into the investment, in that you can have what we call the CSV, the cash surrender value. So if you decide to terminate your policy and it has accumulated a lot of cash, the premium you've paid and the interest has accrued, you can always have that. So yes.
So it's not really like a waste of money.
It's not like like a temporary insurance. Is like, you can say it's a waste of money, because after the period you're insured, you don't get any cash back.
I see.
But for permanent insurance, there's always a cash value based on what you've contributed into investment portfolio and what the interest that come back to you.
Yeah.
If it's whole life, maybe in form of dividends or interest on the investments that is in that insurance. So I see permanent insurance as an opportunity to invest, and your investment is like paying yourself. I would like put it like paying yourself to be insured.
Okay.
Like I'm investing, but it takes care of my it's like a free insurance.
So what percentage of money that you put in do you take out, that is yours, and what percentage of that money is for the insurance company?
Well, it depends on how it's structured.
Okay.
There's a lot of things to consider, but when you have a permanent insurance that has an investment portfolio in it, I think a larger percentage of it, apart from what services the insurance, goes into your investment.
Oh, okay.
So the investment functions to keep your life insurance afloat. So it's like you're just investing and you're getting insured for free. So let's say you have a life insurance with a face value of $500,000, and your premium is like maybe $200 every month. Let's say what services insurance is $20 every month. The
Okay.
180 goes into the investment, and based on the investment vehicle you have, it works to bring interest. So then if you look at it that way, the face value is for free. When you die, your beneficiary get paid a certain amount of money. So it looks like I was just making an investment. So some people with that, what we call CSV structure, their retirement, their children's education payouts, or take care of their maybe even critical illness. Depends on how it's structured. You find that the investment can take care of you while you're alive.
Okay, so is it the face value that makes the insurance more better than bank, putting your money in the bank or buying property?
Well, what makes it better is the tax aspect of it, because it's a tax-free investment. If you die, when eventually you die, the money your beneficiary gets is tax-free 100%.
Oh.
But if you die, your property gets taxed, what we call capital gain tax, and it's taxed heavily, almost at 50%.
Okay.
The person pays that huge amount of money, and they may not even have that amount of money to pay. So sometimes, if your insurance, your life insurance is structured very well, it can even accommodate those expenses to take care of your estate.
Okay.
It brings that,
pay
your tax on the property that is being passed to your beneficiary, because your beneficiary might lose the house because they don't have that huge amount of money to pay for capital gain tax.
Okay.
So that's the difference, the tax aspect of it, because it's 100% tax free.
Okay.
Some people structure it in a way that it pays them like pension. Like upon retirement, they get a certain amount of money monthly, which is still tax free. So people compare it to like other pension plan, but we must understand that other pension plan like the CPP, they're not tax free. They are put into consideration in taxing you on or any of all the incomes that comes to you. So it's not tax free because it's an after it's taken away before deduction. So there was no tax for before your CPP. I mean, there was no tax before you took it with the CPP. The CPP is deducted before your income is being taxed. So when you eventually take it out, that's when you get taxed.
Yeah, we're learning a lot of times. So the CPP is
like Canada pension plan.
Canada pension
like for people who work, you get a Canada pension plan, but then it gets taxed.
Yeah.
But if you put money into a life insurance and structure it in a way that it takes care of your pension or takes care of you when you retire, it comes to you tax free. It's like a free money, your investment, everything that accrues to you, you get it tax free.
Okay. Some people may be wondering, they don't have enough money to start investing or start going into life insurance and all. We know how it is to pay bills and all that. Is there like a limit amount you can use to start if you want to go into this?
I wouldn't say there's a limit, but there are certain things that influences your premium.
Okay.
And one of it is your age, your sex. Like, I think when they say women are more, will I say,
less risk.
They are more responsible, so their risk is less than. Right, so yeah, so it depends on it. Are you your health? It's also taken into consideration your life, the way you live your life. Are you somebody who's susceptible to like taking risks? So the less risk of a risk you are, the more insurable you are, or let's say the lesser premium you get.
Okay.
But I think age plays a major factor, because in that we die sooner when we age, right? Someone who is 60 years is closer to die than someone who is 20 years. So the earlier you take out insurance, the better, and also the earlier you take out insurance, the more cash value you build in it. So that's one of the major things I would say influences how much you get, but there's no cap. Another major thing is your face value. So you can't tell an insurance company, I want a 500,000 or 1 million face value for when I die. Your premium definitely should be able to commensurate all these things. So so coupled with your age and every other thing, that will tell me your premium. But you can get a permanent insurance for as low as $50 a month.
Wow.
Yes. A permanent insurance, not a temporary insurance, because I see adverts for insurance, $20, $15, and people are so eager to take it, but there's no cash in it. It's only a debt payout, and most of them are term insurance. Can you guarantee you're dying in the next 10 years? And the negative thing about temporary insurance is that though you might have like a term in your contract that says it's renewable, which means it's renewable with no medical condition, they don't take into consideration your current medical history, but then they take into consideration your age, and age is a major factor that influences premium. So you might get a temporary insurance for like 20 years that is at $15 premium now, but by the time you're 20 years it might be $300 a month. Because I had this experience with someone. So if it's not just once, I've seen so many people that has become an issue. Then you look at the 20 years that you've gone, and if you don't continue, it's a waste, because it's a term insurance, there's no value in it. Then how do you continue paying a higher premium for probably a very low face value? So
the question now is, do you think if I start paying $50, making investments with $50, maybe 5 years time, do you think I can be able to like increase that amount? Maybe if I have more income, or do you think, I'm just capped at that $50?
No, it's not usually capped. Like usually for every insurance, depending on the face value, there's always a cap. Your premium might be $50, but you have a room for maybe an extra $150 every month. Because the more you put in, the more interest, the more your investment portfolio grows. And within the first few years of taking out a policy, I think that's when your money works better for you. So it's always advisable to pump in so much money, like for you to build that your cash surrender value. Because in the first few years, that's when you have less contribution, right? So your money is not really working so hard. But if you have enough money that maximize the room you have, then your money start working for you earlier. So you can. Depends on your contract as well. That's the limitation, depends on the terms of your contract, but there's always room for adjustment. Yes, there's always flexibility.
So when I was doing research for this, I came across Universal Life, Whole Life, and the likes. So how do you advise your clients to pick one, or what do you suggest that is the best, or the place?
Well, it's not a one size fits all. It's about the client. We have what we call client needs analysis. Like an assessment based on the one-on-one. What do you need? Why are you taking a life insurance? Is it for estate preservation? Is it for
investment?
Yes. Is it for investment? Is it for taking care of tuition fee? Is it for retirement, or for death benefits? So it depends on it. Then we take into consideration the client's risk tolerance. or investment goal. Do they want to gain more because the higher your risk tolerance, the more you want to make, right? Clients whose risk tolerance are very low usually go for whole life policy because there's always a cap guarantee that they guarantee a particular percentage regardless of what the market is doing. You are getting this percentage every year.
Okay.
But with universal life, it's more flexible. Like we talk about previous about flexibility of changing. Universal has more flexibility, and it has more, like what I say, investment interest. But then the market could come down. So the thing is that you have to study like an investment, let's say, buckets that you're putting the money to see how has this investment or this market been, what has it been performing in like 5-10 years. That's like you predict like the market before you pick the investment to put your client's money into, and you can have a guarantee to say, at the worst case scenario, this is what this market has performed. So it's not a one size fits all. Like I say, it depends on the client and what the client, but you have to present these options to the client and how each works for the client to adopt. Yeah.
And when picking the company, is it the clients that picks the company they want to work with, or you're the one that recommends a company, an insurance company?
Well, I work with WFG, the World Financial Group, and the good thing about us is that we don't have affiliates. We are not affiliated to any insurance company, so it's all about our clients, the family we serve. So, like I said, the need analysis, we look at the client to say, okay, what suits you? This company might be what suits what you want. So let's say this company is offering this investment portfolios, and this is after you study the market, because we sell insurance through education. We sit with our clients and we educate them on how insurance works, the differences, and what insurance can do for them based on their wants and needs and their goal, their future goal and aspirations. Then they look at this portfolio to say, okay, I think this is what works for us. So we can't tell you what company to invest with, but we tell you what each company has to offer. Then you have to elect which one suits your need best.
Yeah, so when you say education, does that mean you are open to several meetings until your clients decide?
Oh, of course. We do more of education without really looking for something by. Like I said, the fun that I found in this, like you talked about being a lawyer. And
yeah, you're very passionate about it. I'm sure you're ever going to law.
No, I got the experience. Like I said, I did this for myself, and I found something. Because I can't tell you what I don't believe in. So I sat down with someone and I was educated. My eyes were open. And coming from a country where we don't really, like I see a lot of GoFundMe flying out each time someone drops. And that's annoying because we have investment portfolios with just like $100 a month that takes care of this, that gives you peace of mind. Like the major thing is having that peace of mind to know that if anything happens, you shouldn't be a burden to people being alive. With little as $100 a month, you can get a sophisticated investment or insurance portfolio that takes care of even your funeral. It takes care of your will. You don't have to pay. It has a portfolio where you can write your will, edit it as choice, free of charge. So why will you not take the opportunity
and you see money for your loved ones?
I think, oh, that's the best part of it. Take care of your estate while you're dead. So it's your job.
Yeah. And if you're sick and you have chronic illness,
we have insurance that you can incorporate critical illness policy in it, and there's a standalone critical policy. And the most interesting thing about this critical policies insurance is that critical illness insurance is that you can put in a rider, return of premium, or if at the end of this investment or whatever you can call it, I don't get sick, you get every single dime you contributed.
Wow, I've not heard of that.
Yeah, why won't anybody want to take it?
Yeah, because
you
mean like
you insure yourself in case you get sick. Then you have a face value that influences the amount of premium. But if at the end of this, let's say 20 years, I don't get sick, I get every dime I contributed.
Oh, nice.
Why won't someone do that?
Yeah.
Why would someone get sick and then wait for GoFundMe to get the best care they want? So I think it's all about not having the proper education or ignorance. So that's why we approach this through educating parts, where we tell you how you can make your money work for you very well.
I would like to dive a little more deep into the critical illness. So does that mean if maybe in the space of 5 years I contributed $5,000 and maybe the person is sick and it may be costing like $50,000 to get the best treatment? Is your company giving out just the $5,000 that I contributed, or you guys will just take care of the sick until the person is fit?
Okay, now this side it works more like life insurance where you have a face value.
Okay.
That also influences the premium you pay. So let's say you take a critical illness for 100,000. If you ever get sick, and your premium is like will I say $100 a month. With just maybe an extra $60, you get the rider for return of premium. So the way I see it is like a sensible saving. Like, let me say I take out $200 every month and I save for myself.
For the unknown.
For the unknown.
Yeah.
And then let's say, and once you start contributing, let's say you start contributing today and you get sick tomorrow, you get the 100,000, not what you saved.
Oh.
Yes. Contribution can never be more than the face value.
Okay.
So if you're contributing 200,000 because your face value is 100,000 and you have a return of premium right, and let's just hypothetically you say you contributed $200. In 20 years you wouldn't have contributed up to 100,000. At the max you have $40,000.
Sure.
So if you don't get sick, you get your $40,000 back intact without a penny getting out of it. And if you get sick within that 20 years, you're getting the 100,000. So what do you lose?
Nothing.
You get a peace of mind. you get your savings.
Yeah.
And in case I get sick and I need money to fly myself to the best medical doctor, you're not stressed. You don't die because of worry before the sickness itself kills you, because you're getting the 100,000.
Yeah. So talking about the tuition, so is it like you contribute, say I have a child now, he's 1 year, I'll contribute until he's 18 years, then the insurance company will give the child the money, or is there like I can take it out anytime I want?
Well, there's always flexibility with investing with like into life insurance, because you can always, in fact, you can terminate any policy, but the question is, you have to honor the terms. There's always, like, if you have a cash surrender value in your investment and you decide to terminate, you only pay the cash surrender charges. There's always a cash surrender charge because you are terminating the contract. And remember, your CSV does not only have your contribution but also the interest that's accrued.
Okay.
So it's not like you're paying a percentage out of what you've contributed. The percentage most likely comes out of the interest on it.
Okay.
So you're still not at a loss if you decide to terminate. But why will you terminate when you can always borrow from your CSV? You can borrow from yourself.
Yeah. All right. So I'd like to ask, and I know many of you must have the question, is nothing is certain. Let's say you're contributing $500 and something happens, you lost your job or something, and you can't meet up with the bills. Can you downgrade?
Yes.
Okay.
You can downgrade, and also depending on your policy. But the answer is that yes, you can downgrade. Okay. But you can't just downgrade your premium. In some situation, you have to downgrade the face amount as well. That's the payout.
The payout as well. Or can you pause it until the situation is
You can also pause, depending on the terms. But I say the basic implication of that is that if something happens, they take into consideration how the policy has been going on. Like if there's if what you've contributed is not sufficient to keep the insurance policy afloat, it will elapse.
I see.
It means because there's always, like I gave example of contributing $200 and $180 going into your investment portfolio and $20 services the insurance. So if you don't have enough amount in your investment portfolio to service the insurance, let's say you've contributed for like 6 months, or let's say 5 months, which is $1,000, right?
Yeah.
And yours, the amount of service insurance is $20. How long will that $1,000 minus the $100 that's left to service for the 5 months? You have $900 left. So if $20 is taken out every month, how long will it last to service the insurance before you bounce back? and why the investment portfolio is still performing and bringing interest, because it doesn't just sit in serviced insurance, it's still in an investment portfolio, so it's increasing.
Yeah.
So that's why I said earlier it's good to contribute way more than that's like to the cap of your contribution earlier on at the beginning of your policy. So you have a limit and a max you can. So that is it. So you can always pause if you have enough cash. They can service the insurance side of the investment while you take a pause, because you already have a CSB that's in an investment portfolio that is paying for the insurance.
Yeah.
So if it's there that the $20 can leave to service the insurance, so that's why I say it's an investment where you invest and you get yourself insured for free. So if your investment portfolio is still working, then you can actually take a pause. And sometimes maybe you feel, oh, this is too much for me. You can actually downgrade the premium as well as the face value.
So they don't, like I have a circle of friends that don't really know what life insurance and investment is. Is there like an advice, or is there like a best time for them to start investing or start looking into it? What advice do you have for mostly immigrants who, you know, where we are coming from, they don't really know what's the benefits of having insurance?
Okay, I think what just came to my mind is this saying or a quote that the best time to plant a tree was 10 years ago, and the second best time is now. Because today is going to be 10 years ago Sunday. Okay. So, but it's something you need to do now, because like life insurance, it gives your family peace of mind from financial burden when you're no longer there. Yeah. And aside from that, it gives you peace of mind too, because you know that things have been taken care of. Like I say, it takes care of different aspects of your life. Mortgage, you know that if you're dead, your mortgage will be paid. So that's why when you have like life insurance, you can factor in some term insurance that takes care of things like that. School fees, mortgage, you know, every of your need that are term. Because if I have a mortgage now, probably I need to pay my mortgage up in 20 or 25 years. And I put a term insurance that takes care of my mortgage for 25 years. Once that need, I used to use the word expires, I need not pay the premium. So if I was paying a premium of $100, and after 25 years my premium drops to $80, because the $20 added to it was for my mortgage. Now I no longer have that need. And it's also convertible, because when you look at, I've paid for this for 25 years and the need is expiring, you can actually merge it into your permanent needs, so that you don't lose that face value that was supposed to take care of your mortgage. So it's not so complex, but when you talk about the whole aspect of life insurance like this, it can be overwhelming. That's why when we sit down with the client, we look at what is your major need now, what is your future goals and aspirations, where do you want to be in 10, 20 years. Then we factor all those things. It can be layered. Yeah. It doesn't really have to be compounded, it can be layered to take care of
everyone's situation is different.
Yes. So apart from taking care of your loved ones and giving them peace of mind from financial burden, it takes care of you as well. Because like say critical illness, you're not bothered about getting sick and not having the money, you're not bothered about losing your job and not being able to take care of your family, because life insurance investment can take care of all those things for you. Okay. Yeah, so you can even use it as a retirement plan. Oh, I want to retire by the time I'm 50. And by the time you're 50, you're being paid till you're dead. Wow. And aside from being paid, your family gets something when you're gone. And also the very good, the very exciting part of it is that you can actually borrow from yourself. That's why you say being your own bank. So banks don't have the license to sell seg funds. Only people who have, insurance sell seg funds. And you wonder, okay, you put your money in the bank. How did the bank make so much money with your money? Yeah. It's about being I'm not saying you shouldn't save or have money in the bank. It's about being wise, getting your money not just to work hard for you, but better and, you know, smarter. That you don't have to really suffer to get your money to make something for you. It's like you sit down and you get your money to do the job for you. Yeah. So the answer to the whole thing is you should start now, and I will leave
Chi's handle and email address and link to which are at the description box. Kindly get in touch with her and book an appointment. So it's nice having you.
Thank you so much.
See you some other time.
Yeah, it was a pleasure.
All right, thank you.
Okay.
Bye.
Bye.